Good evening. Thank you for coming to this, which is the final lecture in the President's Lecture Series for this year. We have heard a number of distinguished lecturers during the course of the year, and we'll do so again tonight. And I want to thank President Engstrom for making this series possible. I'd also like to note that this is the 25th year of the President's Lecture Series, and so it's something of an anniversary. And I'd also like to thank Professor Richard Drake, who has organized that series over that period. Our speaker tonight is Professor James Galbraith. Professor Galbraith received his PhD in economics from Yale University in 1981, and after that time, he held several positions in the United States and on the staff of the United States Congress, including executive director of the Joint Economic Committee. He has taught economics and a variety of other subjects at the University of Texas Austin's Lyndon Baines Johnson School and the Department of Government. From 1995 to 1997, he directed the LBJ School's PhD program in public policy. Currently, he directs the University of Texas Inequality Project, and some of you may have had the opportunity to attend Professor Galbraith's seminar this afternoon when you heard something about that. It's an informal research group based at the Lyndon Baines Johnson School. His current research, which Professor Galbraith reported on this afternoon, concerns the measurement and consequences of inequality in the world economy. He also serves as a senior scholar at the Levy Economics Institute and as chair of the Board of Economists for Peace and Security, a global professional network. He writes a column on economics and political issues for Mother Jones, as well as occasional commentary in many other publications, including The American Prospect, The Nation, and other major newspapers. He's written numerous books, the most recent of which is Inequality and Instability, a study of the world economy just before the Great Crisis. That just came out last month, I believe. And he has also written several hundred scholarly and policy articles and co-authored 2 textbooks, one of which some of you may have actually used when you studied economics. In the summer of 1969, as a graduate student in economics at the University of Wisconsin, I took a required class in the history of economic thought. We, of course, studied the founders of the discipline, Hume, Smith, Ricardo, Malthus, Mill, Marshall, and the like, but also, thankfully, some of the famous critics and contrarians, Marx, Henry George, Thorstein Veblen. At the time, and this is still true, like most students of economics, or I hope like most students of economics, I had serious reservations about economic theory and how it explained the world. It just didn't seem to account for all the things that were obviously important in economic life. So I liked reading the critics, and in particular I found the ideas of the institutionalist economists helpful and compelling. Institutional economics seeks to explain economic outcomes by analyzing the organization and control of the economy and the structure of power which determines whose interests prevail. Institutionalists look beyond the typical constructs of economic theory, things like free competitive markets, atomistic firms, rational consumers, and the like, to include the fundamental economic role of government, the socialization of individuals, and the consequences of a business and political system dominated by large corporations. Professor Galbraith, our speaker tonight, stands in that institutional tradition. His work, like that of his father, John Kenneth Galbraith, provides us with a critical, engaged, and scholarly analysis of the broad range of important public economic issues. It's an analysis informed by the realities of modern economic and political institutions. And I know that you will find it, and I will find it, as compelling as I found the history of economic thought in 1969. Please welcome Professor James Galbraith.
Professor Barrett, thank you very much indeed. President Instrom, Professor Drake, it is a great pleasure and a privilege to be here tonight to deliver the President's lecture in honor of Lucille Spear, and I'm very pleased to be here in the presence of members of the McElwain family. And I want to thank you also, Professor Barrett, for that very kind introduction, and particularly for your words at the end about the connection between the work that I've been doing and the larger tradition of institutionalist economics. I'm serving this year as the president of the Association for Evolutionary Economics, which is the professional society of institutionalist economists. And so I've been more conscious this year, perhaps, than in the past, of that very important linkage in the lineage of economic thought. And I have as my intention tonight to speak about the events of the last few years, and particularly the great financial crisis, very much in that spirit. 4 years after a great event, such as we all lived through in September and October of 2008, there is a powerful urge, a psychological urge, to move on, to close the books, to say, okay, lessons learned, we'll try not to have that happen again, let's focus on the future and not dwell on the disasters of the past. This is a sign, I think, of a healthy optimism, but it may not always be the wisest approach to an event such as this. It's the kind of healthy optimism which is encouraged, of course, when the responsible authorities, those who arguably bear the largest share of responsibility for the disaster, remain in power, or anyway, it's a sentiment that they encourage for understandable reasons. In the academy, there is a parallel urge to fold the events as they recede in time into the pre-existing narrative, into the understanding that we had before of how things work. And this is partly reflected in the language that is chosen to refer to these events. So the Great Moderation, which is what economists like to call the period from the 1980s up until the middle 2000s, was followed not by a crisis or a collapse or anything quite so fundamental, but by what they came to call a Great Recession. A Great Recession, now, which means an event not out of the ordinary experience of the post-war period, and that would be inevitably followed by a recovery. Perhaps a slow recovery, but a recovery nevertheless. In other words, one is conditioned by the language that is being used to believe in a certain pattern or cycle of events. And the object here is to preserve power. In this case, by doing something that economists are always very good at, which is economizing on thought. Discouraging questions, and keeping the interpretation under the control of those who had control of it before. In this way, the overturning of academic hierarchies, the reorganization of academic departments and disciplines, and perhaps the restructuring of journals and the whole business of internal validation of research and promotion of personnel does not come into question. Yeah. But what I would like to spark is, and maybe right here in Missoula, would be the beginnings of just such a revolution, or at least the re-evaluation that might lead toward a restructuring of the way we think and do economics. I would like to do the same thing in politics, but that's perhaps too ambitious. And so as an economist, I'll stick to the profession that where I have at least a capacity, perhaps, to reach an audience. So my thought tonight is to review the crisis in light of the prior climate of economic thought. That climate was not the great material determinism of the 19th century, Ricardo, Malthus, and Marx, with its deeply pessimistic view of how things would work out, especially for working people who would essentially never escape a subsistence level of existence. Nor was it the emergency interventionism of the much more optimistic John Maynard Keynes in the 1930s, who believed that the government had the capacity, particularly if it was being directed by a spirit like Keynes himself, to fix the disasters that were befalling the economy in the Great Depression. No, the general spirit with which we approached these events was, I think, the managerial optimism that we first developed in the 1950s, which held that stable economic growth and steady progress were the normal course of events, that periodic deviations were, of course, inevitable, but likely to be minor, manageable, and reversible, that the markets which gave us both the trend and the cycle were largely honest and reliable, and best, generally speaking, left to their own devices, that resources and the environment did not pose binding constraints on the system. And within these conditions, it was proper and normal to hold political leaders responsible for economic performance, to reward and celebrate them when times were good, re-elect them most notably, and to punish and replace them when times were bad. And this attitude, which does essentially integrate the political system into the economy, but in a managerial role of a, generally speaking, healthy and resilient system, is deeply embedded and remains deeply embedded in our political culture. Now, at some level, many of us have known for a long time that this story isn't quite right? That there are parts of it that don't work. Maybe we've come to the realization that while economic growth is a good thing, it's unlikely to continue forever. Or that the dominance of any particular country, even our own, however much we might love it and be proud of it, is unlikely to be a permanent feature of global civilization. We perhaps have realized that resources do matter and that they are becoming more costly, that the environment, in some sense, either does or will ultimately impose a serious constraint. And we perhaps may recognize that markets can fail, that the rigorous assumptions that economists make about what it takes for markets to allocate resources efficiently are not assumptions that are plausible in the real world. Information is asymmetric, as Joe Stiglitz likes to say, but there are many other ways of making the same point. We can also understand that politicians are not, in fact, all-powerful, and they may not, in fact, be benign. That is to say, their objective may not be the best economic performance. But it seems to me that we have not yet, for the most part, systematically put these doubts together. And one reason is that to do so would place us in strict conflict with the core message of our underlying economics. It would conflict with an intellectual discipline that many of us absorbed quite young and have held for a long time. Now, it seems to me if you look at the sweep of history over a lifetime since the Second World War, that we have been through the beginnings, at least, of an examination of these points before. And that was in the 1970s. Now, from 1945 until 1970, there was very little, by the way, to disrupt the notion of American dominance, stable growth, ongoing prosperity. But in the 1970s, that idea was severely challenged, and it was challenged by events that at the time we referred to as oil shocks. These were very disturbing. They led to a period phenomenon known as stagflation, the combination of inflation and unemployment. And they posed a terrific challenge. In fact, in economics, those of us who came through professional training about this time are very aware of the fact that in economics they forced a major revaluation and retreat of the previously dominant Keynesian models and paradigm. And then there was another change, a dramatic series of events at the end of the 1970s and the early 1980s, the start of the Reagan administration, which was presented to the country at the time as a revolution, and in some respects was. Caused an enormous disruption, an extreme revaluation of the currency, high interest rates around the world. But the effect of this was to start the United States down a different path of economic growth, which continued through the first Bush administration and the Clinton administration up until 2000. Something quite different from the model that existed before, but one which nevertheless conveyed a new image of ongoing and continuing prosperity. Many people already believed this in 1984, which is why Reagan won re-election. They certainly believed it by 1999 and 2000 at the peak of the information technology boom. What was that model? It was a model of growth built on the expansion, the rapid expansion of private credit. Right? Model built on venture capital going to technology firms. A model built on increasing indebtedness of the household sector. A whole range of developments which had not been the foundation of economic expansion in the first half of the post-war period. It was a model also which generated steady and ultimately rapid increases in economic inequality, an enormous division between the few at the very top of the income and wealth structure and the larger population, an artifact of the reliance on capital markets to value individuals' portfolios and to provide the financing for economic expansion. And as this happened, the resource issues faded back into the background. We forgot about them. We went back to driving bigger cars. Right? Commodity prices collapsed, and we allowed ourselves to believe that this finance-driven growth could go on for a long time, and that the resource issues which had bothered us in the 1970s had somehow gone away. Well, that ended in 2000. That ended already 12 years ago with the collapse of the information technology boom. And President George W. Bush took over just as that happened faced with an extremely difficult situation, and I'm not one to express sympathy for George W. Bush, as you might imagine, but he was faced with an extremely difficult situation in which the foundations, 20 years foundations of economic growth had come to an end, and yet the expectation of performance for American political leadership had not. What to do? That new administration sought to maintain growth in an unfavorable climate, and it did so by a sequence of measures. The first, in the wake of the September 11th attacks and the recession of 2001, was to cut interest rates and encourage people to spend and go out and borrow to finance their consumption, which people did. There was then a modest boost from the war, mainly in Iraq, and I'm not going to say that that was intended to boost the economy, but it was certainly had that effect for a short period of time, but not a very large effect. There was an increase in public spending generally in 2004. And all of this contributed to stabilizing the system, but not to restoring the prosperity that had existed 5 years previously. What else could be done? The only answer that suggested itself in any plausible way was to foster yet another round of growth of private debt, the growth of credit, expansion of bank loans. And the only plausible place to place those loans was in the housing sector, a sector which had already a very strong development of credit. It's a sector which for 60 years had been the foundation of household wealth formation in the middle class. Extension of long-term, relatively low interest rate, stable mortgages, which were then sold to Fannie Mae and Freddie Mac and held by the federal government for to a very large extent, had created a mature housing finance market. But this then posed another problem. If you have a mature market in anything, it's very unlikely to grow rapidly. The market for loans to solid credits was one which would only grow with people's incomes and new household formation. How could this problem be solved? The answer is that there was a second market that had not been tapped, a market with an unlimited potential for growth, and that was the market for bad loans, the market for loans that would not be repaid. Right? There's basically no limit to that as a mathematical proposition. And I say this quite frankly, to generate and achieve a rapid growth of spending based on this kind of finance, underwriting standards had to be reduced. And they were. There had been in the Clinton administration already a very substantial deregulation of the financial sector. In 1999, the repeal of Glass-Steagall. In 2000, the Commodity Futures Modernization Act, which prevented the regulation of credit default swaps, a rapidly growing area in the financial sector. In 2001, this was followed by desupervision. In a very literal sense, 500 FBI agents right after 9/11 were removed from financial fraud and assigned to counterterrorism, which is understandable, but they were never replaced. That's less understandable. In 2003, the head of the Office of Thrift Supervision, a Mr. Gillerin, and here I see that there may be some people with some experience in the forestry industry in the audience. He came to a press conference with a stack of the Code of Federal Regulations and a chainsaw. Now, what message, those of you with experience in forestry, do you think he was trying to send? It was not. And for the rest of you who are merely gardeners, his colleagues came with pruning shears. This was not a subtle effort. And the response in the industry was, as you might expect, it was to encourage the most aggressive actors in the sector to take advantage of the regulatory leeway that they now knew they had. To give you just one example, taken from a very good book by two journalists, Bethany McLean and Joseph Nocera of Fortune and the New York Times, the company AmeriQuest made a practice in some of its offices of greeting its new loan officers with a welcome gift that consisted of a baggie containing scissors, tape, and whiteout. The book also reports that some of the loan officers were given a routine working dosage of crystal methamphetamine to improve their job performance. I mentioned this once to a colleague in Europe at a conference, and she said, "But that's a rape drug." I said, "Yes, precisely, that's the point." The language here is, I think, as good an indicator of what was going on as any we have. An Alt-A mortgage given to someone who did not document their income was a liar's loan. Right? We had loans given to people with no income, no job, or assets. That was a ninja loan. Those of you with backgrounds in physics and the nuclear weapons business would understand that a neutron loan was a loan with a teaser rate that was going to go up, explode in a couple of years, destroying the people but leaving the buildings in place. The loans were bundled in packages of 10,000 or so. They were securitized. They were sold off in this tranched way. And the part that was left as the so-called equity tranche, which was the little piece that was not given a AAA rating, was called toxic waste. Was this incidental to the industry? Fitch, one of the three largest rating agencies, did a little study in 2007, doing what the others had not done, looking at the underlying documentation, and they said that the results were surprising. They found evidence of abuse, fraud, or missing documentation in virtually every file. Okay. It was a massive decline in the ordinary standards for the functioning of the financial sector. I think there's another way we can use language to describe this that's helpful. These documents, millions of them, they were, if you looked at the first word on the document, it probably said mortgage. But what's a mortgage really? A mortgage, in my estimation, is a long-term, fairly stable loan given to someone who's going to pay it back and amortize it over time. These were not mortgages in that sense. A proper way to think about them is to say these were counterfeits. Right? These were counterfeit documents. And a counterfeit, if you've ever been part of a counterfeiting ring, you probably know, has to be cleaned up before it is presented to the open market. This is called laundering. Right? That was the job of the ratings agencies. The French word is blanchissage. Laundering. That's what they did. They took these counterfeit mortgages and they passed them off as AAA. Right? And then, and again, if any of you have been in the business of trading contraband, it has to be sold. That's an operation called fencing. And that is what the commercial and investment banks did. They fenced it. That is to say, they took this merchandise and passed it off to a unwitting investment public, much of it elsewhere. Who were the marks? In Michael Lewis's book, The Big Short, there's a wonderful passage. One banker says to another, Who's buying this stuff anyway? And the answer comes back, Dusseldorf. Dusseldorf. Dusseldorf was the headquarters town for one of the big German banks, IKB, which actually failed, but the broader point is there. If you go into a restaurant and the wait staff, you overhear them talking about the food and they're using words like scum, sewage, sludge, you probably get the impression that the business is not entirely honest, and you're probably not wrong. And I haven't even begun to mention CDO squared and cubed, synthetic derivatives, nor the entire business of credit default swaps issued by companies that couldn't begin to pay if the loans went bad. The inference to draw here is not simply that the financial crisis was in fact foreseeable, although it was foreseeable. Some people did foresee it, and some perfectly good investors made hundreds of millions of dollars betting against the payment of mortgages in subdivisions where 30% of the houses were empty. It's not also simply to say that the concepts that we normally use to describe it, the words like bubble and instability and riskiness, are not quite adequate. They're too innocent. Right? They're too little emphasis on the underlying element of deceit. But it also goes beyond simply blaming people. The idea that bad, greedy, amoral people took control of major financial institutions and ran them into the ground, although that did happen. The point here, I think, is to recognize that this was a part of the way the system was meant to function at that particular point in time. Fraud was enabled, encouraged, and facilitated in the pursuit of the appearance of economic growth. And that was the path of least resistance toward what was a politically necessary impression of prosperity, whether you measure it by employment rates, the growth rate of GDP, or the profitability of the business sector. Without that, and without the fraud on an unprecedented scale, those underlying goals would not have been achieved. The appearance of performance in the economy at this moment depended upon it. And yet, in economics, in my profession, this particular feature of what happened remains a taboo topic. You will not see it discussed at the meetings of the International Monetary Fund, which I have attended. It was already quite a breakthrough that they invited me. I don't think they'll do it again. You will rarely see it mentioned at the meetings of the American Economic Association. In most of the published literature, at most a footnote. And I think until we come to grips with what happens, we will not be in a position to deal with it. Now, Herbert Stein, who was the chief economist to Richard Nixon, and a very amusing man, once articulated Stein's law, which holds that when a trend cannot continue, it will stop. And in a similarly profound vein, I'm going to say that when a fraud is exposed, it will collapse. Right? But there's a larger point still about the nature of institutions and regulation that's involved here. And that has to do with what happens next, or what can happen next in this situation. I was brought up, admittedly, a resistant and kicking and screaming graduate student in the face of the then prevailing orthodoxies, but still I was brought up in the traditions of economics of the period after 1970. And one of the things that you learned then was about the nature of regulation, which was always presented as, particularly if you were a liberal, something necessary on occasion to deal with pollution or to deal with safety and other issues of public concern, but nevertheless an imposition on private business. something which had costs as well as benefits, and therefore economists were always talking about assessing the ratio of these two things. And that perspective is not entirely false, but it also seems to me that in important respects in the kind of society in which we live, it's profoundly misleading. It's deeply misleading. It is not the way this subject should be presented in the first instance. Because practically everything we do as members of a complex network economy depends upon our willingness and ability to trust what other people are doing, and trustworthiness is something which is conveyed to us by an effective system of regulation. Right? I'll give you an example. Lettuce, my favorite example. Right? Most of us here in this room will think nothing of going to the store, buying a head of lettuce, taking it home, maybe you wash it under the tap, and then you put it on your table and you serve it as a salad. Right? Why do you do that? Don't you know where that stuff has been? The answer is yes, you do. You have a pretty good idea. But you believe that the United States Department of Agriculture is reasonably trustworthy and is able to, most of the time, ensure that that's a reasonably clean product that's not going to make your family sick. Right? And you plug your electrical appliances into the wall because you understand that they've been checked out and they're not going to catch fire most of the time. Right? And you get on airplanes because you're reasonably confident that the air traffic control authorities are going to keep them from running into each other. Okay? And if you weren't, you wouldn't get on unless you were a military pilot. Okay? Does it matter? Well, I invite you to go to China, live there for a little while, and ask how many times you're going to find lettuce on the table. And I bet you won't find it even once. Why not? Because even if you grew it in distilled water, hydroponic conditions, in a bubble, nobody would believe you. It's not a problem of the technology, it's a problem of the regulation. And without the regulation, the market simply doesn't exist at all. And the proof, by the way, of this proposition is that you can, in fact, find lettuce in China. Right? I know because my sister-in-law manages stores in China. Where can you find it? Sam's Club. Comes in from California, USDA, and they trust that, and they know it's a good deal. Right? Well, the financial system's the same way. The financial system requires an authority that gives us confidence that the people we're dealing with are not stealing too much. Right? And when that when that trustworthiness collapses, this is not just an incidental problem of a business cycle. This is a fundamental collapse of strategic institutions at the core of a free capitalist system. Absolutely a collapse, which cannot be repaired and will not easily be repaired in any short period of time. And it has happened once before in modern history, and that was in 1929, 1930. And if you ask by what time was it repaired, the answer is probably around the 1970s. People began to believe in the financial system. Up until that point, what was there was very, very strictly regulated under very tight controls because people understood that anything else was extraordinarily dangerous. So now we come to the painful part of the talk, which is what happened after this meltdown occurred. And the economists came in and applied to it their previous understandings of how things would work and how a recovery would occur. And part of that entailed believing that a recovery was a natural process which would occur automatically even if nothing were done. All right? This is the doctor who only has one patient, that patient's always gotten better, and the doctor concludes that patient's never going to die. Right? I'm sorry, I know many of you would like to believe that's the case, but it's not the way most doctors work. Right? But economists seem to have taken this particular view. Right? And I think that they did believe that they could help matters. They might even believe that they could prevent, and to some extent they could prevent, an even worse catastrophe. But I think what happened can be described as flights of fancy, even of fantasy, in three waves. The first of the waves I'll call the credit market and monetary policy fantasy, rooted in the magical superpower of the Federal Reserve. This begins with the idea, actually associated with the original TARP program, the Troubled Asset Relief Program, that one could restore a market for all of the securities, these terrible toxic securities, simply by buying some of them back, and that would create a price, and then things would start, liquidity would be restored. Lots of mystical words fly around here. And things would start being all right again. And in particular, as President Obama started saying almost as soon as he took office, and even before, that the policy would then lead to credit flowing again. And when you think about that, you ask, okay, what's the metaphor here? Well, it's a plumbing metaphor. There's a blockage, right? You've got to pour money into the banks and put it under enough pressure, and some of it will come out to the people below. It's not my experience of a banking relationship. I always thought of this as a contract. Again, this comes to the institutionalist perception, actually, that in fact credit is a legal relationship which requires both a borrower and a lender on a reciprocal basis. This idea of the power of monetary policy extends to our own time with the notion of quantitative easing, a vastly overrated concept, a great fancy word. I'd never heard it before 2008, and I wish I could never hear it again. But with the notion here that there was some mystical way in which creating money in the system is going to cause people whose houses are worth less than their debts to be able to refinance those debts or to start a new borrowing. And there is a view here that perhaps the Federal Reserve could just create a little bit of inflation, which is something people also recommended for the Bank of Japan for the last 20 years with absolutely no success. So that's the first wave of fanciful responses to the crisis, attributing to institutions that are of undoubted use and value much greater power than they actually have, and then being disappointed when things don't work out. But in the meantime, having lost time that could have been devoted to a more serious approach. The second wave was a fiscal fantasy. And this was associated with forecasts that were being made about the depth of the slump and the size of a spending package that would be required to offset it. We know a lot about this now because we have the documents from the early months of the Obama administration. And let me just summarize briefly. I think what happened here was that one had as a starting point official and unofficial forecasts that were built upon the normal historical experience of fluctuations of the economy, and on the perception that if you were facing something that was unusually deep, the recovery would then be unusually rapid. All right? This is a very optimistic view, but optimism in this circumstance works against you if you happen to be wrong. And taking it, accepting the consensus, impaired the ability of the administration to speak frankly, even internally, about how bad things were. The reality is that in an extreme situation, the consensus opinion, particularly of economists, is always going to be wrong. That's the definition of an extreme situation. That's another theorem, by the way. But in order to recognize and act on that, somebody has to be willing and able to overrule the consensus and assert an extreme view. And this was what was missing inside the administration. So Larry Summers considered that Christina Romer's estimates, which by the way were the same as mine, of how big the output gap was, were, in Summers' words, extraplanetary. And while the White House memo, I was pleased to say, did attribute those numbers to me, Professor Romer, who was the chair of the Council of Economic Advisors and presumably considerably more influential and respectable than I was not permitted to put her numbers on the same paper. Right? So they became just the view of a fringe guy far out on the left rather than the view of the president's chief economist. And to this there were further burdens added. One of them was the notion that if you did enact a very large program, the capital markets would jump back at you and raise interest rates, vitiating the effects of that program. Again, expressing a failure to understand that what had happened here was a fundamental change in the way those markets for money, that determined the interest rate on U.S. federal debt actually operated, that in the extreme situation, everybody wanted to hold U.S. Treasury bonds and were willing to do so at practically zero interest rates, as we have observed is the case. But as late as early part of 2009, economists with a strong sense of what would be normal refused to acknowledge or accept or build into their thinking this basic fact. And the result was two things: a so-called stimulus package, which was both too small and too short. The word stimulus itself conveyed a misleading impression, namely that you could get away with something that would be in effect for a few years and then no longer necessary. And all the calculations led to the view that you could get away with something that would not only be in effect for a few years, but also would not be very large. The program was, in short, oversold and inadequate, conceptually flawed, with disastrous consequences politically, because when the results fell short of what was projected, it became impossible to argue that they had done any good at all. You couldn't make a coherent claim that you understood the scale of the effect that you had in fact had if it was obvious that you were as far off as you were on the underlying forecast. And here we are, in the third wave of fantasy on these questions. This wave has emerged with the campaign. And to mix metaphors a little bit, I'd say it has two wings and a tail. There's a right wing, a Republican wing, which fundamentally says that every problem we have is due to government. Regulation, taxes, the health care bill, which hasn't taken effect yet, uncertainty over the health care bill because it hasn't taken effect yet. Essentially, anything that the right wing does not like can, with equal credibility, be sourced as the cause of the failure of the economy to respond. And it just becomes a question of catering to people's prior beliefs. And then you have a left wing, well, it's a sort of a short left wing, which is making two claims right now. One is that things are basically all right, and that we are on the track of economic recovery, right? In which case, you can all turn over and go back to sleep. And the other is that to the extent we need to do something, it should be to benefit the manufacturing sector and to bash the Chinese. Which has, I think, two very clearly identifiable sources for that argument. One is the fact that the manufacturing states are the swing states, Michigan, Ohio, and so forth. And these arguments are powerful there. Right? You would not expect them to be the political theme, the economic policy theme of the campaign if the swing state was Texas, and probably not if it were Montana or California or New York. And the second is that the Chinese, by and large, do not vote in American elections. And then there is the tail. I said two wings and a tail. The tail is the part that's shared in common by both wings. And it's in the background, that's why it's the tail. The tail is the idea that our real problem is not anything I've been talking about so far, but deficits, debt, and the looming crisis of Social Security and Medicare. And it's in the background because these are not topics that you speak of in front of voters in advance of an election, but I promise you the next day they will return to become another spurious element of the economic policy discussion. Why spurious? Because they do not, in fact, bear at all on the problems that we actually face. They are part of an ulterior agenda, and yet spending time on them, talking about them, and still worse, acting on them, is going to distract us from the things that we must do. Now, what must we do? I've talked a little bit about energy and a lot about finance, and it seems to me that until we focus in a disciplined way on these two issues, we are going to remain in very deep trouble. The energy problem, it has the very important environmental dimension, but it also has a cost dimension. Oil prices go up in the $100 a barrel range. This is a direct drain on business profitability. If we allow speculative financial markets to drive these prices up and then down, we are acting to allow a choke chain to be placed on economic activity, and also creating an environment where businesses understand that investment, whether it is in energy using or energy conserving activities, is likely to become unprofitable at some point in the near future. And what business needs actually is this promise of steady profitability in order to engage in long-term investment. If we don't begin to think and deal about this issue seriously, it's a problem that we're not going to overcome. And on the financial sector, I've spoken about the problem of confidence and trustworthiness, but there's also a problem of size. The sector is too big. It doesn't do anything that is fundamentally useful to provide employment and activity in the underlying economy. It is a charge on the profits of the rest of the economy. And it needs to be brought back down to a reasonable scale, as was done in the 1930s. But only 20 years ago, this sector was maybe 60% of its present size. There's absolutely no reason to believe that that extra growth has served any fundamental function of value to the performance of the American economy. Can we meet the challenges of energy and finance? That requires us to take a serious view of the role and function of government. To maintain a government for a substantial period of time that is serious and dedicated to achieving those objectives, that can build a credible capacity to set and enforce standards in both of these areas. There is no automatic mechanism that is going to resolve either of these issues, and neither can be resolved so long as we allow our attention to be diverted constantly to the non-issues, such as I've already discussed. To get where we need to go, we're going to have a disciplined political movement, one which ultimately has an influence on, takes control of one of the major political parties. Something that can sustain, ultimately, an institutional, a legal, and an engineering effort. None of that is seriously underway at present, but we can begin to talk about the role of knowledge institutions, and particularly about universities, in bringing together the community of minds and talents and expertise that would begin to make such an effort possible. I entitled this talk, "The Great Crisis and the Dismal Science." I trust you have sensed the irony that was intended. The crisis was indeed, and it remains a very great one, and it is not over. But have we approached it in an open-minded, dispassionate, and scientific spirit? I think when you look at the performance of the economics profession, the answer to that question is no, we haven't. We've approached it in a defensive, self-justifying, and evasive spirit, and that is an attitude we need to challenge. So as for the character of the science, the most dismal thing about it, surely, is that it has not been nearly dismal enough. Thank you very much.
Thank you, Professor Galbraith. Professor Galbraith will take questions. This is being recorded for MCAT at least, and so we would appreciate if you have a question that you go to one of the two microphones, and to the extent possible, please focus your questions on the lecture and on the matters that were discussed this evening. Thank you.
So you spent quite a bit of time working over the financial industry, and one of the key things, at least in my perspective, that's happened in the financial industry over the last 15 years has been the expansion and facilitation of speculation. So I wonder if you could just take some time and talk about the different kinds of tools and changes in regulations that have allowed that, and then the effects that speculation has had. You mentioned the oil industry, but I think it's also apparent in a number of commodities as well. I think the food crisis that we faced in 2008 was, again, not so much because of the rise in price in corn because of ethanol, that was a component, but ultimately it was speculation that really caused the spikes. And so I'd like to kind of get your perspective on that element of the financial industry.
It's a controversial issue still amongst economists, but I am certainly persuaded that where you're dealing with commodities that are essentially fixed supply, there is a capacity for financial speculators, for people buying futures contracts for essentially to take advantage of the appreciation, to drive up the spot price. And I think that is what we saw when the price went up to $147 a barrel, the price of oil, in the summer of 2008. There was a great deal of talk about the great growth of demand in India and China as the source of that, and then people looked at that growth of demand. It was a steady 3% per year, and it seemed to have no relationship to the scale of the run-up in prices. And then suddenly the prices started collapsing. What happened there seems to have been, in part, that the Commodity Futures Trading Commission started to take an interest in the position that speculators were taking through an exchange that the CFTC had up to that point said was being regulated by the Financial Services Agency in the UK rather than by the US, where it was in fact physically located. When they took a different position, or began to, traders started dumping their positions and the price started to fall. So it strikes me that is pretty strong evidence that the case that you're making, which is that you have the capacity if you are, let's say, trading in the Goldman Sachs Commodities Index to drive the price up and down, is in fact a correct case. And I think that is a serious problem. That is the problem which commodities regulation was intended to address from the beginning. And what we've seen now is that law, particularly the Modernization Act in 2000, created so many holes and gaps in the law that it's very difficult to, it's very difficult to get a handle even on what's going on, let alone control it. That needs to be dealt with. The other big area here where one has a speculative force of considerable importance is in credit default swaps, which are essentially very closely related to the bonds that are the underlying reference instruments. And so it's very possible that what is driving the very adverse movements in the bond markets for European sovereign debt are movements in the derivative markets, in the credit default swap markets, which are, again, very difficult to actually see. And so, again, major problem. And I think that the issue is how to deal with it is not entirely straightforward, because one feature of the modern age is that these are contracts which can be executed anywhere and much more easily moved around to escape legal jurisdiction than was true 70 years ago. So it's not obvious to me that there is a ready solution to this problem, but it is obvious to me that it's a serious one. Sir.
You told us you would speak to Saad. You said you would talk about economics and not politics, but I'm wondering whether you could comment on how reasonable centrism is as a response to the problems you've discussed.
Centrism. I'm a centrist gradualist revolutionary myself. I mean, I suppose my response question would be, what is the center of what? I am rather fond of my Texas friend Jim Hightower's remark that in the center of the road, got nothing but yellow lines and dead armadillos. But, you know, in many ways, I think that dealing with the problems that we face requires drawing on the expertise of people who are in the center by virtue of not being political. Right? There are bank regulators out there, people who have experience supervising financial institutions who are not political people. Some of them got their experience in the Reagan administration working for Ed Gray, who was President Reagan's appointee to head the Federal Home Loan Bank Board and a true American hero. There were people who were appointed by President Bush, Sheila Bair of the FDIC, whom I admire greatly. In the energy area, I don't think this is a political question. In the environmental area, I don't think it's a political question, except insofar as some political forces are, make it into one. But there needs to be a mobilization of the ability to act as a counterweight to the forces that are tending to blow the system apart. And that's what we're missing.
Professor Galbraith, thank you very much for your insightful and witty comments. It's a delight. And you are carrying on the torch from, your seminal torch from the industrial family. So let's go back home. Not Main Street, although Main Street depends on Wall Street, but academia. You're speaking to students, to dignitaries. And when I went to grad school, I was with the idea that university was supposed to wag the dog, right? Does that make sense? And what happened to, you speak about the dismal science. This dismal science came from the Harvard, Yale Business School economy. What happened to the influence of the not yet dismal or abysmal science on the government? If I'm not mistaken, only Rubini warned the government. The IMF, he had a speech in 2006. The IMF, they made fun of him, saying, "Look, we're on the brink, on the edge, sorry, of a collapse." So, could you comment on that? What happened to the influence of the university as far as advising government, business, CEO, Wall Street? It seems to me they were more or less accomplished. They followed the flow. Am I totally wrong or pessimistic? Or?
No, I think this is you're raising a deep and serious question. There was at one point, certainly 40 years ago, in American academic life, in economics, a diversity of views at the top of the profession. The Harvard Economics Department, of which my father was a member, had members that ranged from Kenneth Arrow, Vasily Leontiev, Albert Hirschman, Simon Kuznets, a very wide range of people who, interestingly enough, to a substantial extent, grew up in a particular period when they had serious public responsibilities. They had the mobilization for the Second World War. They had my father was responsible for price control in that period. This gave them a connection to the world of policy that was not abstract, that required them, if they were going to be successful, to be deeply informed about how things worked. In the next generation, this link was broken, and what one got instead was an essentially theological view, an essentially removed view of first reasoning to policy from first principles. Right? And this was, I served on the congressional staff in the 70s and 80s, and this transition was already, clearly underway at that time. You still had many people who could testify from the ground of practical experience, but you had many people coming in who were testifying, again, from textbook first principles, never leaving the academy. I think that second group is now basically thoroughly in control of economics, and this has not changed at all. I wonder if there has been a single appointment to an economics department of anybody from a dissident tradition pre-crisis. Has there been one? I'm not aware of it. Certainly not one of the so-called major departments, which have become kind of intellectual ghettos, frankly, self-enclosed, right? And, there is a discussion about the nature of economics, and a certain distinguished colleague and friend of mine, Paul Krugman, has characterized it as a debate between saltwater and freshwater. And the point I would make is that both of those environments, saltwater and freshwater, are notoriously sterile. And the interesting stuff is all going on in the backwaters. And I'm pleased to say that that's where I work, and I invite you to embrace that characterization, because that is where evolution occurs, isn't it? Yeah. Biologists in the room can confirm that for me. I think that's probably true. So it seems to me what needs to happen is for any institution which has a little bit of intellectual space to foster a diversity of views and a real engagement with the policy questions that we face, so that, economics is supposed to be useful. If it isn't, I don't know the point of having it. Sir.
Thank you for your talk. I enjoyed it quite a bit. And I guess the backwaters of economics, and maybe a little bit to the forefront, since Daniel Kahneman got his Nobel Prize, is behavioral economics and the critique at levels of the conception of human nature at the core of a lot of economic theorizing. I wonder if you could engage the question of what effect the truncated view of human behavior that economics relies on had on the crisis that we had and our failure to respond to it adequately.
Well, that's a very challenging question. It is interesting that when the economists needed to find someone to honor with an insight into human nature, they had to go find a psychologist too. Professor Kahneman. That, I think, does tell you something. The reservation I have about the new behavioral economics is that it is engaged in a dialogue with the neoclassical economics. That the primary function of it appears to be to act as a test of propositions which anybody already knew were preposterous to begin with. So it tells you in interesting ways, often using classroom experiments, that people are not the way the economics textbooks say they are. They are not fully informed, hyper-rational optimizers who don't care about society. They they're, whatever the model of the economic person actually is. And I already knew that. So can we move on and actually talk about, if we're going to study psychology, study it in a context that actually brings us into contact with the problems that we have.
You said that the stimulus was both too small and too short.
Mm-hmm.
What would have been appropriate?
What was needed, I think, and what I said at the time was needed, was above all, to characterize the program as a new strategic direction. In other words, to create not only to fill the output gap with stabilizing expenditure, which is a useful thing to do, but to create a set of institutions and a climate of expectation that would bring private investment into play at an appropriate time, along a new path, a new vector of activity, which seems to me ought to be dealing with the energy and environmental issues. There's a lot of work to be done. All right? So you create a climate and a set of institutions that give people a reasonable expectation that doing that kind of work will be profitable, and they'll start to get into it. Instead, if you talk about stimulus, you're saying what we're going to do is we're going to put some spending into the economy, and just at the time, if you happen to be a business foolish enough to have made an investment expanding capacity, just at the time that your plant comes online, we'll pull the stimulus out, right? And guess what? If you're a sensible business person, you'll say, hey, I'll wait a couple of years and see what happens, right? And that's, of course, I think the situation that we observe. So it was partly a question of scale. But I think making it a question of scale really misses the point that one has to have a set of direction, a sense of direction and purpose for the strategy to work out over a 10 or 15 year horizon. Sir?
Sir, the austerity, the tonic of austerity, where does that fit in the rubric now? What is, why the resurgence? Certainly not a new idea. And what do you see to be a logical consequence?
Very interesting question, and I had some notes on austerity in my remarks, which I skipped over. It's part of the reaction to the perceived failure of the stimulus packages, both here and in Europe. And something for which an opportunity opened up as a result of the sort of free-for-all environment that that we're now in on economic policy. Now, it's particularly unfortunate that some very prominently well-placed economists provided a spark for this with studies that allege that in certain cases, if you cut your budget, cut your public expenditure, you'll grow rapidly. The examples given are typically Australia, Canada, and now, if you're in Europe, you hear a lot about Latvia. Truly remarkable. Latvia? How many of you honestly could pick it out on the map from the other two? Right? I mean, it's a very small country, right? I heard a presentation by a senior European official, I think it was a European Central Bank official, at a meeting in Berlin 10 days ago, on this. And it did not once mention the tiny detail that if you look at Latvia on the map, it's got a big neighbor, it's called Russia, right? Latvia is a transshipment point for Russian oil. It also is selling off its forests. That's where its economic growth is coming from. 1/3 of the Latvian population is immigrating, right? This is not, can you say that, can one remotely say that the small export-dependent country, which may be experiencing growth following a cut in its public expenditures, could be a model for France, the 5th largest economy in the world, or the UK, or Italy, the 8th largest economy in the world, or Spain, where the headlines today are 25% unemployment, 1 in 4, right? And the headlines on the UK 2 days ago were second dip of the recession, the double dip. Small countries, yes, maybe. If you have oil and you have a big neighbor and it's growing and you cut your budget, you may get some growth. This is not translatable to the experience of big countries, and it reflects the strained nature, the willingness of high officials to make extraordinarily implausible arguments because they think they can get away with them in the present environment, that should even be really advanced as an argument. Thanks for the question, sir.
At the beginning of your lecture, you spoke about revolution, so my question has to do with that. Corporations get their individual rights from the 14th Amendment. Do you feel a possible part of a solution could be to go after corporate individual rights in order to return a matter of accountability to individuals involved in corporations?
Actually, I don't, to be frank about it. And I think that the corporate veil does not excuse individual officers from responsibility under the law. And I think that nothing in the law has decriminalized fraud. Fraud is deceit. Deceit is per se problematic under the law. We didn't have to deprive savings and loans of their enterprise status in the 1990s in order to prosecute the officers. And 1,000 of them were, in fact, indicted, prosecuted, convicted, and imprisoned for fraudulent conduct. This is a major failing of the present environment, that we have not done this. We have not pursued a single major case, right, that I'm aware of. You know, one might say if only Attorney General Holder was still alive. But seriously, we have a structure of institutions to deal with this problem. We have not used them. And fundamentally, until we do that, we cannot convey to the rest of the world the notion that we are serious about establishing a trustworthy financial sector. Sure.
I have a question. So you mentioned that the money that was given through the stimulus was meant to free up the lending market. So my question would be, if it didn't really succeed as well in doing that as we anticipated, can you think of any other ways that it may have been better spent in order to boost the economy in a different sense?
Sure. I recommended at the time that certain parts of the program be open-ended. And the one thing I really wish they had done was to provide open-ended support to the budgets of state and local governments, just to begin with. Because while they did provide money which helped substantially, there were still dramatic cutbacks, and at the end of the day, the state and local sector basically offset the stimulus to a very large extent. So what could you have done? You could have set look, in this crisis, the last thing we want to do is to cut school teachers and sanitation workers and parks and libraries. We want to keep them going because they're providing activity that the private sector isn't providing. And so the federal government should have just cut checks with the proviso that you don't raise your taxes, you don't lower your taxes. So you can't game the system for the duration of the crisis. That would have been a very sensible step. What else could we have done? I would have, and I would still, have improved the conditions under which people could take early retirement under Social Security. Let them take it a few years earlier without penalty, 58, 59, for 3 years or so. I mean, not permanently, but just so that the current generation of older workers can get out if they want to, if their job prospects are bad, or if they're just tired at this point and would like to retire, make it attractive for them to do so slightly earlier, and this opens up jobs for younger people. As an emergency measure, but it would have been good policy, reduce the age of Medicare to 55. Right? That was the simplest. That was the simplest legislative proposal I've ever been associated with. You just take just take a pen and where the 5 is, you write 6. It's really quite easy. I mean, it's technical amendment, poof, or where the 6 is, you write 5. Excuse me. What would that have done? Workers who are only hanging on to their jobs because of desire to maintain their medical insurance could get out. And so that would also have relieved the burden on a lot of companies and made life easier. So I think, there were things that could and should and perhaps still should have been done, should be done. Sir.
2 questions. Very interesting talk, thank you very much. But I'm surprised you didn't make a bit more out of what you mentioned you were discussing this afternoon, inequality. Because I would have thought that the US government does have views about middle class growth, which is very much affected by increasing inequality. Isn't that an issue, and how could you tackle that? Second question is, I think you're a bit cavalier about future debts. Surely from even just from a private investor point of view, particularly if you're trying to do things short-term that you talked about, like a stimulus, sort of measures you just talked about, don't you need a credible medium-term plan to bring down the deficit, to give you a sort of macro stability, that you've got some idea of where you're going to go in the future?
Right, thank you. On the first topic, I spent an hour or so on inequality this afternoon, so I suppose I was inequalitied out. The relationship of inequality to the crisis is, I think there is an integral relationship but in some sense, one has to be careful about which direction causal flows are going. My sense is that to a very substantial extent, what we measure as inequality is the same thing as the run-up of private debt and the capitalization of the value of financial firms. Those two things were, if you look at inequality and tax records, they're happening at the same time. They're essentially records of the same facts. So I tend to view inequality because of the nature of my research project, from that detached and statistical framework much more than I view it as a causal force. And that may be, one can think about it in a different way, but that just happens to be the approach that I feel the data that I work with make me most comfortable with. On your second question, which has to do with the projections of the long-term deficit. The problem here is that those projections, and it would have taken more time to explain this in my talk than I had, but now since you've asked, how much time do we have? The problem is that those projections on which so much of the political debate turns are not at all credible. And a little analysis of them would convince any reasonable person that that's the case. From a political and institutional standpoint, the Congressional Budget Office was established to help members of Congress compare the effects of pieces of legislation, mostly small pieces of legislation. In order to do that, you had to have a common baseline. For that purpose, it doesn't matter whether the baseline is a reasonable forecast. It just has to be the same one for every piece of legislation, so that you're not comparing one piece of legislation at a 10% interest rate with another piece at a 2% interest rate. And that's an important function, but it is not a forecasting function. When you put these things together into a forecast, it is, however, necessary that they be consistent. And the CBO forecasts are not consistent in that sense. They project, for example, that the Federal Reserve will raise the short-term interest rate from 0 to 4 or 5% in the next few years, and that this interest rate, higher than the growth rate, will persist, while at the same time the underlying growth of GDP stays at 2% and the inflation rate at 3% and the inflation rate at 2%. Not going to happen. They raise the interest rate by 400 basis points 2 or 3 years out, and every mortgage in the country will go into default. It's an absurd proposition. Right? If you allow the debt to compound the way they, if the debt were to compound the way they propose, then the inflation rate would rise, and the debt to GDP ratio wouldn't go where they say it's going to go. There are many other. Those are core difficulties with the forecast, and it matters. If you assume much more accurately that we're going to have, much more plausibly, that we're going to have very low short-term interest rates for the indefinite future, then the debt-to-GDP ratio stabilizes. You can work this out. The mathematics is not controversial, and I've done a paper on it. That will go up, and then it stabilizes. And then if you have economic growth, it'll start coming down again. And that, of course, is the historical trend. So I think working on the assumption that there's some terrible crisis out there because the CBO says there is not a plausible, that would not withstand the scrutiny of their forecast, and is also not the view of the capital markets. Plainly, if there were going to be some great crisis in federal finances as a result of these projections, nobody would lend to the federal government for 30 years at 3%, which is precisely what they're willing to do right now. So it's clear to me that it's both implausible on the face of it and not persuasive to people who actually have money in the game.
I think we have time for one more question.
Yeah.
With the student debt advancing into the trillions and the widening gap between the 1% and the 99%, I guess as someone who wants to go into higher education, I feel like I'm just stepping into this black hole. Mm-hmm. Do you have, I guess, any advice of how the younger generations could be more fiscally responsible and just how to get out and progress from this point?
I should go into investment banking, you know. And particularly if they take my advice about the prosecutions, there may be vacancies in the profession. Seriously, I think we are setting ourselves up for a very major problem with student, and we're in the stages of a very major problem with student debt, in part because of the way it is excluded from personal bankruptcy provisions. And so we're going to have to rethink how we do that. I've really nothing against a system in which people take out loans to finance education on reasonable long-term terms. But if they're going to be faced with interest burdens that are going to escalate and from which they cannot escape, even given life choices, which may be service choices of teaching and other professions, caring professions that do not generate large incomes, then we need to examine and rethink and restructure how we do this, because we should be providing. I mean, the educations are extraordinarily important for the future. The debt burdens are not.
Again, thank you for coming and for your warm reception for Professor Galbraith, who's provided us, I think, with a very stimulating, wonderful, informative evening. Thank you.